everyone, and welcome to the LexisNexis complimentary webinar in partnership with the Helen Brown Group and the Obama Foundation, XYZ Understanding Next Generation Donors. My name is Corinne Bressler, and I will be the moderator for today's session. I just want to remind everyone that today's webinar is being recorded. Today's speakers will respond to questions after their presentation via the web, and those of you logged on to WebEx are encouraged to submit your questions throughout the conference by clicking on the Q&A button in the upper right corner of your WebEx console or in the full screen. So I'd like to welcome Angie Stapleton, Assistant Director of the Helen Brown Group, and Elizabeth Sproma, Prospect Research and Management Associate of the Obama Foundation. So Elizabeth, I will hand it over to you to begin.
Great, thanks Corinne, and welcome everybody. Thank you for joining us today. I'm going to let Angie say hello too, just so that you can hear our voices.
Hi, this is Angie. Thanks to all for joining us.
And as we get started, also just a reminder, if you have questions, please type them in the chat, and Corinne will be moderating for us, and she can read them out at the end. So we are going to be talking about next generation donors today, and we wanted to just kind of set the stage and give you a sense of the different generations that we're going to be talking about, and just to kind of bring them to life a little bit. We wanted to give you some touch points for each generation. So the first generation that we may touch on a little bit, we call the matures, and these are people who were born in 1945 and earlier. So these are people who were coming of age under the shadow of World War II. They may have seen It's a Wonderful Life in theaters. And thinking about the economic context that these people grew up in, these people were children of the Depression. So that's something that definitely impacted the way that, and continues to impact the way that they think about their finances and their giving.
The next generation, the baby boomers, these are folks who witnessed the Kennedy assassination. They may have marched with civil rights or the first women's rights movement. And they were around when the economy started to rebound. So they started to make money, and that may influence the way that they're thinking about prosperity.
And then the next generation is Generation X, which we'll define as people who were born between 1965 and 1976. So these are people who probably saw the Challenger explosion on live TV. They may have gone to or wanted to go to Live Aid concerts. They probably lined up to buy records or tapes of Madonna and Michael Jackson. And they grew up during the sort of the boom economy of the 80s.
The next group, Millennials, which we're defining born between 1977 and 1995. These were folks who were probably in their formative years. During September 11th, they can definitely tell you exactly where they were when that happened. They were coming of age during the environmental revolution, where talks of climate change started to really take off. Probably one of the first elections, if not the first election that they could vote in, brought about our first African-American president, and they probably spent a lot of time listening to, no doubt, the Dave Matthews Band and some others like that. And then they also, they grew up in a time where money was flush. They probably grew up in households where they could afford to purchase things they wanted and take trips and have experiences. But then when they were in college or coming out of college, just as they were about to start their own financial journeys, the recession hit in 2008, 2009. So this is a generation that's felt the weight of student loans and having a hard time entering some of the job market.
And then our youngest generation is Generation Z. So these are people who were born in 1996 and later. Many of them are still children, and sort of the people at the edge of this generation are just now starting to come of age. Angie and I, neither of us is a member of Generation Z. We both feel pretty out of touch with what their pop culture references are, so we're just going to let that one lie. But if you think about sort of the social and cultural forces that are shaping these are people who are growing up in the age of the Me Too and Black Lives Matter movements. Every Town for Gun Safety is something that has been at the forefront of their sort of their formative years. And from an economic perspective, these are people who may have, you know, as children in their families, felt the impact of the Great Recession in a very real way. So just to kind of put those in your mind as background for our conversation today. And most of our attention today is going to be spent probably on, I would say primarily on millennials, but also with a little bit of reference to some of the other generations, especially Gen X and Gen Z. But understanding that, of course, the generations are all interrelated. And so the matures and the boomers are very important to this conversation too, because in many cases, it's those generations that have created the wealth that is now being passed on to the younger generations. So we have a few slides here that we are going to go through very quickly. We wanted to put them in mostly for your reference so that you can look back at them after the presentation because we feel like they have some really good stats. But the main thing that we want to drive home is that we're talking about an enormous transfer of wealth that's going to be happening from the boomers and the matures down to Gen X, millennials, and Gen Z to the tune of almost $60 trillion. And some of this money has already started to be passed between the generations and will continue to do so, you know, for decades. So again, I'm just going to flip very quickly through these slides. We're not going to stop on them, but definitely take time to go back and look at them and think about them in the context of your prospects. And Angie, please feel free to jump in if you have anything to add here.
The only one I think I'll jump in on is this one because I think it is important. I'm sure a lot of our listeners today, a lot of the people joining us today are based in the U.S., but I think it's important to realize that wealth is being created at astronomical levels globally. I think right now China is actually producing more millionaires than the U.S. is. So really looking at Eastern Asia as a potential for great wealth and great donors.
Absolutely. I think that's a great point. Another point that we want to make is that this wealth transfer is very much on the top of people's mind, but also it's something that still is very fluid. So you can see from this stat, less than half of families have a full succession plan already in place. And even of those that do have a full succession plan, many of them don't have it written down. So this is something that families are thinking about, and I think it's a real opportunity for us in philanthropy to be a part of that conversation and to think about it as we are cultivating donors, whether we have donors who are members of multiple generations within one family, or if it's the case where we just have donors who are poised to inherit large amounts of wealth. One of the reasons that this is still in flux is because there are some very big implications from the new tax law that was passed last year that will have a big impact or could have a big impact on the way that families are planning to transfer wealth. So these are just a few of the points that we pulled out of the tax law, but I would say, you know, the big headline, especially in the context of this presentation, is that the amount of inheritance that can be passed down without being subject to estate tax has now doubled for married couples. So potentially money that might have gone, I think it's too soon to say for sure, but money that might have gone to charity in order to avoid some of those estate taxes now can be passed down to the next generation. And so what that might mean, I think it could mean a few different things, but what that might mean is in situations where the strategy might have been to cultivate the boomers or the matures who created the wealth for a bequest or some other type of planned gift. It may be a better strategy at this point to focus more on the generation that will be inheriting that wealth, because potentially they could be inheriting a lot more.
Mm-hmm. I also want to pause here and mention dynasty trust, because I feel like this is something I'm seeing more come up and up. And so dynasty trusts, if you're not familiar with them, they're a type of trust that you can create in Delaware, South Dakota, and they essentially can be funded with cash, stock, other assets. And they put in place a structure where they pay each generation only some of the trust proceeds. So you essentially put money into this trust, and then you can, or whoever's created the trust can then determine which generation will receive how much of the trust. And so it's a great way to grow your estate free of taxes because the money is taxed when it comes out. It pays capital gains tax when the assets are sold, but it's a great way if they, put in the maximum of the 22.4 million that the tax exemption allows, they can put that money in and then it can grow and be worth far more several generations later.
That's a great point, Angie. And to that, or sort of related to that point, we are seeing, and the literature sort of backs this up, that more and more individuals, particularly high net and ultra high net worth individuals, are using professional advisors to help manage their money and to help them with their estate planning and their philanthropic planning. And so it's becoming more and more common to use fairly complicated structures like the Dynasty Trust because more people are getting more sophisticated advice from professionals. And one other point just quickly on the new tax law is that there's been a lot of talk about the fact that the standard deduction has increased for individuals, and one concern among nonprofits is that that could lead to less incentive for people to make charitable donations, because if they were relying on the deductions from their charitable donations, they may not be now that the standard deduction is raised. But the good news, at least from the perspective of major gifts fundraising, is that the limit on cash donations for people who do itemize has also been raised. And I think for most of the prospects who we're looking at the major gift level, they're still going to be itemizing even above the larger standard deduction. And so the amount that they can itemize, or the credit that they can get for cash donations, has actually been raised too. So I think that may be a piece of good news for us. Again, these are just kind of some good statistics that we aren't going to spend a lot of time on today, but we wanted you to have this for reference. But just to drive home the point, which I think we are all aware of, is that there is an increasing concentration of wealth at the very top, which means that it's probably a fewer number of families that are holding a greater amount of wealth. And that is leading to a need for, or one of the consequences of that is more sophisticated planning. And so we feel that as prospect researchers, it's really important for us to start to understand what some of those complex structures are and how people are using them to think about wealth and to think about wealth across generations.
And who's holding that wealth? I feel like this is a good time to talk about that. So right now, I feel like baby boomers are definitely still holding a good percentage of the wealth, and they're definitely still making most of the financial gifts that we're seeing. Most philanthropy is coming from that generation. But Gen X is quickly approaching their prime giving years, and there's also a lot of self-made wealth within Gen X. So we've seen studies that have said 20% of Gen Xers are planning to increase their giving in the upcoming years. And so I think as they are moving up this pyramid or sitting at the top of this pyramid, it's a good time to start approaching them because they're starting to think about how they're going to be giving that away, both as outright gifts and through bequests and plan giving.
So another thing that we want to just touch on briefly as far as just sort of thinking about the overall what's happening in the background that's shaping some of the ways that people are thinking about their wealth and philanthropy is a shift that we're seeing in the overall economy to a greater focus on collaboration and cooperation and sharing. So, we hear a lot of talk about the sharing economy. And this, there are some larger patterns that sort of play into this, and Angie has some great resources here. If you can, I don't know if you can see it on the screen, but you'll get the slides after this, so definitely blow it up so that you can read, because there are some great sources here to dig into this a little bit deeper. But just hold that in your mind, that sense of the importance of collaboration and of sharing. And I think that translates really clearly into some of the choices that we see millennials making and some of the priorities that they have for their own lives. And some of this, too, I think goes back to those economic trends that we talked about. So for millennials, we're seeing that there's much less emphasis on material possessions and ownership, and they're much more interested in experience. And I think that that means that we need to think very differently about the way that we are interacting with those people when they're in our prospect pool. So that the way that we want to think about cultivating them and stewarding them as donors is probably going to look very different from how it looked in earlier generations. This is, Angie pulled this quote out, and I love it because I think that it, number one, we chose it because it's a quote from a next-gen donor herself, so we thought it was great to let her describe her generation. But also, we like it because it points to, I think, both a challenge and an opportunity for us, and it just kind of emphasizes the fact that these donors are very different than earlier generations, and also that they think about themselves very differently. And so I think that what that means is that we have to be very creative. And when I say we, I mean prospect researchers, but our whole fundraising operations. And we need to also work very collaboratively so that we as researchers are talking to our gift officers about some of the new patterns that we're noticing with this generation as a whole and with the individual prospects as we're looking at them for our gift officers. So it's, you know, this is a hard thing because I think in many ways it means that we have to revamp what we've been doing.
But I think on the positive side, looking at this generation, one thing, as this quote says, she's got a lot more money to give, but the duration will also be a lot longer. So whereas, you know, traditional philanthropy in years past, you may have worked with a donor for, let's say, 10 years, these donors, you know, your organization may have the opportunity to work with them for 2 or 3 decades. So, you know, they may be starting at the age of 30 and they'll still be donors if done properly to your organization when they're 60. So it allows a lot of opportunity for those relationships to go deeper and hopefully be more transformational for your organization and also in the lives of these individuals who are giving their time and money.
Absolutely. And so what are some of these differences that we're seeing with the new generation? There's I think there's a shift happening in how people think about their giving and even how people define what giving is. And so we really like this quote from Justin Rockefeller where he talks about his tool belt and how he maximizes his tools for social change. And I like that because I think it captures sort of the holistic approach that a lot of younger people are taking to their philanthropy, so that they're not just looking at what we would traditionally define as philanthropic giving, where you write a check to a nonprofit organization and get a tax deduction for it. They're looking at how can they use all of their money to approach problems that they see in the world and make them better. And so one component of that is what we think of as traditional philanthropy. But along with that, they're also making impact investments. They're making political contributions. So they may be involved in funding advocacy organizations. And this is reflected in the fact that there's a growth in sort of non-traditional giving vehicles too. So we're starting to see people, rather than just creating a foundation to hold their philanthropic dollars, they're creating LLCs, which gives them the flexibility to use that money in all of these different ways.
I think my favorite way that I've heard this discussed is to think about money in terms of buckets, and this next generation doesn't really want to separate their money into buckets. They kind of think of as having one big bucket, and how they live their life and how they give their money should all be congruent with each other. So, you know, they may want to make gifts to a certain organization. They may make impact investments to other organizations. They may want their retirement in socially responsible funds. So it's much more, how do I use all of the resources that I have to make the difference in the world that I want to make? And I think that is Fidelity, you guys probably saw this, but they recently had a report on impact investing, and in that report, so they surveyed 475 individuals with investable assets of at least $100,000. And that report found that 77% of millennial respondents and 72% of Gen X respondents said they had made an impact investment, compared with only 30% of boomers and older respondents. So I think there is definitely a shift in how people are thinking about money and how they're thinking about charity as not being just a part of what we do, but how it impacts all of their assets. And I think it's important also just to point out here that the real big difference in this next generation is how, not what. And I think that makes, hopefully will make a lot of people feel better, because I know there's been a lot of chatter specifically amongst older established organizations, you know, what if this next generation, you know, they want to go out, they want to change the world, they want to make, you know, be disruptive and make big differences. What if they don't support traditional institutions that have served our country, our world for years and decades past? So the big thing I think to take away from this is that they're not necessarily, they're wanting to support the same types of organizations, they're wanting to support the same causes, they're just thinking differently about how they want to do that.
Absolutely, and I think that what that means for us is that we need to be talking differently about what it is that we're doing at our institution. So I don't think it's the case that, you know, millennials won't support longstanding institutions. I think they will, but I think that generalizing, they won't support them just because they are longstanding institutions. They're more interested in what are these institutions doing and what is the impact that they're having in the world. And then even drilling down further than that, what is the impact that their individual gift can have at this organization and at the world, and in the world at large. And so I think it's a little bit of a shift in many times of giving. The giving is more directed at a cause or a problem than at an organization. But if you can make the case that your organization is effectively you know, making progress on whatever the cause or problem is that's important to that particular donor, then I think that's something that will be very compelling to them. And especially if you can show, and this is something that we should be doing for all donors, of course, but I think it just comes to the forefront more, and there's more of an explicit demand for it from younger donors, of demonstrating to them exactly what the impact of their gift is going to have at your organization. So these are some headlines that we pulled. We could have pulled many, many more too, and I would kind of just like encourage you all to sort of use this lens as you're reading the news every day to look for sort of non-traditional gifts, because once you start looking for them, you will see them all over the place, because this is something that's happening all the time, and Angie and I are constantly sending articles back and forth like, oh, did you see this? Oh, this is really interesting. Wow, how cool. Because there's a lot of really exciting stuff happening in philanthropy right now. I think it's a really fun time to be in this field. And so these are some examples of gifts that have happened, but that are very different than sort of the kinds of gifts that we might be used to seeing. One that I'll pull out just because it's one of my favorites. If you look at the bottom left, it says parents' hot stock tip leads to $24 million in Snapchat IPO riches for high school. So the story behind that one is that it's a private high school in Silicon Valley, and there was a parent who was on the school's board who is a venture capitalist, and had an opportunity to invest in Snapchat, you know, pre-IPO, and pass that opportunity along to the school. And what ended up happening, so the school, I don't remember what the initial investment was, but it was like less than $1 million. That the school invested from its endowment in Snapchat pre-IPO, and then once the IPO happened, the school saw a return of $24 million on that. So I think that's a really interesting example of a gift where, you know, this donor didn't write a check for any money, but it's, I would imagine, one of the largest gifts the school has ever seen. And so it's just a reminder to us to think differently and to really, number one, listen to our donors about what they have to offer. And number two, be open to trying new things, you know, and be willing to take a chance and think differently about what we count as gifts.
I also want to point out just the bottom right one, the Notre Dame gift, because I think you're absolutely right, Elizabeth. I think so much of philanthropy and how to be successful in fundraising in the this next era is how to become, and we've heard it over and over, how to become donor-centric. And to me, this bottom right one, the one at Notre Dame, just personifies that, because it's a gift where Ken Ricci, who is an alumni of Notre Dame, was really thinking mostly, he has built a very successful company. He has children who are not interested in running the company, and so really it came down to succession planning for him. How is he going to phase out this company in a way that's responsible and you know, provides that's responsible towards the company, but also provides opportunity and the resources for his children. And so he essentially created a trust for Notre Dame, and Notre Dame is one of the beneficiaries and one of the trustees for the trust, so that when he passes, they will be involved with the selling of the company. And so Notre Dame itself has an incentive to make sure that the company sells for as much as it can sell for, because they will get $100 million. But if it sells more, so the company sells for more, then that gift could increase. So I think it's just a really innovative way for an organization to kind of find themselves in a need of a donor and say, we can help you with that. And then also they're receiving $100 million unrestricted commitment from him in the process.
Absolutely.
So back to your point, Elizabeth, about just really thinking about what people, especially ultra high net worth individuals, are, how they're thinking about their money, how they're structuring it, and how you can be involved in that process and hopefully receive a gift in the process.
Yeah, and I think too, this is a good reminder for us to sort of use to our advantage the fact that many of our donors are using professional financial advisors and wealth managers, and to make sure, because it's, you know, we need to represent all sides. So the wealth managers are primarily going to be approaching philanthropy from the perspective of how to maximize wealth and how to sort of preserve that wealth for the next generations. We, of course, are approaching it on behalf of our organization for how can we get the largest gift for our organization, and the donor is approaching it from, you know, how can they support their passions and have an impact in the world. So when you sort of bring those three perspectives together, some really cool things can happen that can work and meet everyone's goals. So this is just a reminder, again, of different ways that that people are thinking about their philanthropy. And I think this is a little bit of a shift, at least in sort of the lexicon that we're using to talk about philanthropy. I don't know if the goals are necessarily different or not, but Angie, you had a great story to go along with this one, if you would share it.
Yeah, I think so. Again, and so Elizabeth and I have both read Generation Impact, which we love, and is linked. At the end of this slide, we have some resources for you, and it's one of the resources we have. But it came from that book, and it was essentially a millennial donor who was saying that she really views her philanthropy as how is she going to make a big impact in the world? What change is she going to make in the world? Whereas she views charity really as kind of a one-to-one transactional gift. So if she sees someone in need, she may make a gift to that person or to that organization, and she considers that charity, but it's not a part of her overall philanthropic goals. And I think that's probably similar to how we've approached fundraising in the past, but I think this generation definitely feels that. Going back to the idea of buckets, is really feeling that. What change are they going to make in the world, and how does that, how are they structuring themselves to be able to do that?
And so one of the things that, sorry, go ahead.
No, go ahead, go ahead.
One of the things that has really been striking to us, both in reading the book that Angie mentioned and just in sort of our anecdotal observations, is the level of involvement that younger donors tend to want, and how early, you know, in what we view as early in our relationship with them as donors, they really want to step up and be involved in a big, big way. And so I think volunteering is an opportunity for us to really engage these donors at high levels. And it in some ways flips the way that I think we have approached this, at least in major gift fundraising, that the volunteering in a very real and tangible way may be important far earlier in the process and before that first big gift comes in. And that people really want to feel that they are making a contribution of their time and talents before they make a financial commitment.
I also think it's important in thinking about how you're engaging this generation, because a lot of them are growing up volunteering. They're growing up already involved in organizations. So we think about, you know, if we think back to the book that we just recommended, they mentioned that 8 out of 10 next-gen donors have volunteer experiences before the age of 15, with 35% volunteering before the age of 10. And I think this is really important because a lot of next-gen donors are coming to your organization with the mindset that they already understand how nonprofits work because they've been volunteering for so long, or they understand how to make a difference because they've been volunteering so long. And they see that, you know, so I think about when often I was previously at a university, and, you know, we may have university students who would come, and maybe we would have like a young board for them, or, you know, a lot of people will have young professional boards, and I think that's really nice for the first couple of years. But when you think about donors who have, you know, 10, 15 years of experience in volunteering, they're ready to kind of move to that next level. And so I think it's important for us as nonprofits to just kind of shift a little bit how we're thinking, and not necessarily seeing that someone is young and kind of immediately putting them or into a certain box, but really thinking about them as an individual and the experience that they're coming with. You know, if they have several years of volunteer experience, or they've, you know, been making gifts with their parents for years, just because they're young doesn't mean that they may not be ready to, one, make a big gift on their own because they've been involved with that process and they know what it looks like, or two, they may be able to serve on a board or to help lead a campaign because they've been involved with those processes for so long.
And I think, too, that providing those volunteer opportunities can be a really powerful tool for cultivating both the older generations and the younger generations at the same time. So if you have multi-generational families who are, you know, in your prospect pool, if you can provide opportunities for the younger generations to be involved in a meaningful way, it's going to be a great way to get them to be invested in your organization and to sort of take some ownership and make sure that that relationship continues through that generation. But also, I think it's something that in many cases will be appreciated by the older generations. One of the things that we've noticed a lot in our reading is that there is sort of this anxiety among the generations who have created the wealth about passing the wealth down to their children, and they want to make sure that their children you know, don't take the wealth for granted and that they accept responsibility for it, and they want to see that their children are continuing in the philanthropic tradition. So if they're seeing that your organization is creating a space for their children to be involved and that you are also invested in making sure that that philanthropy continues, I think that's something that would be very valuable to them too. And so it gives you an opportunity to strengthen both relationships at the same time. And then one thing that we wanted to point out just specifically about women is that particularly in millennials and Gen Z, well, I mean, this is anticipating Gen Z, but with millennials, certainly, we're seeing that women are earning a larger share of the wealth, and also that they are taking a very active role in managing that wealth and in doing the philanthropy. And so don't forget about them, and particularly as it comes to volunteering, I think this is a real opportunity to engage women who maybe had professional careers but have stepped back from their careers to raise their children, but maybe looking for ways to use their skills, and they can make some real contributions to your organization. So yes, if they're interested, I think there's a tendency in some organizations to kind of assign women party planning roles. And I think for some women that's great, also for some men that's great, and if that's where their interests lie and that's where they want to be involved, absolutely take advantage of that, but I think don't assume that, and think about ways in which they can really contribute the skills, their professional skills that they have developed.
One more note on that too, just because as you know, I'm very passionate about that. I think it is important, especially when you have women who have really valuable skills that they've honed in the workplace and they can bring to your organization. One, I think just putting them in party planning roles and things like that is a major loss for your organization, because they're bringing a lot of skills that could really potentially help your organization or save your organization money or raise money depending on what they're doing. And I think it can be a little insulting sometimes if you are not giving them that opportunity. And I also think that it can really help develop those relationships, because if you're, it's one thing to plan a party, and I think some women really love to do that and enjoy that, but other women who have, other skills, if they're getting to speak into your organization and how your organization is run and how it raises money and those types of things, you may be able to form a much deeper relationship with them, which then could lead to a larger gift in the future, because they're going to feel a lot more ownership over your organization if they're involved in that meaningful way.
And so this is another quote, again, from a Millennial. And it just sort of drives home our point about the importance of creating volunteer experiences where people can really feel impacted, can really be impactful and can feel impactful. And so sort of a cautionary tale about don't create, or be very careful if you're creating sort of advisory councils that are in name only, but you're not actually looking for a high level of involvement or advice, or at least be very clear that that's what it is, because often, particularly with this millennial generation, if they're on an advisory committee, they're going to be expecting to give advice and to see that that advice is, if not always taken, at least being considered in a very real way. So we wanted to highlight a few examples of active philanthropists who we feel like sort of embody some of these trends that we've been talking about. So looking at this slide, starting from the left, the couple that you see is Dustin Moskowitz and Carrie Tuna. Dustin Moskowitz was one of the early founders of Facebook, and so that's where their wealth derives from. And we feel like they're a really interesting case study. They are millennials themselves, and they have really taken a lot of this approach to heart. So they are leaders in sort of in the effective altruism movement, which is a very metrics-driven approach to philanthropy, and very impact-focused. So they're looking at where can we have the most impact for our dollars. And their organization that they started is called Good Ventures, and they put out a lot of data that they share with other philanthropists about the research that their team has done and helping them make decisions about their philanthropy. And so they put this out there to share with other philanthropists in the hopes that it will also be helpful to them in making their own decisions. And the other thing that I think is really interesting about them is that they are an example of someone whose philanthropy really transcends some of the traditional boundaries. And so in the 2016 election, there was a lot of coverage, and they made sort of a big splash about their decision to make $20 million in political contributions. So of course, that's not, traditional charity, but I think that for them, it fit into their overall mission of using their money to make the world a better place. And then in the middle is Marc Benioff, who's the founder of Salesforce. He is a Gen Xer, and he, I think, is a great example both because of his own personal philanthropy. He and his wife have made many large gifts in the city of San Francisco, and he's very vocal about his feeling that, you know, it's his obligation to give back to this place where he has been so successful. But he also has been a leader in corporate philanthropy, and so he's been very upfront about the fact that philanthropy is a priority for him both personally and at his company. And he also has been a real cheerleader for getting other companies in Silicon Valley to make philanthropic commitments. And so he's urged companies to take the 1% pledge, I believe is what he calls it, where they pledge 1% of profit to charity. And so I think he's a good example, again, of sort of some of those boundaries starting to break down, but also of the importance of peer-to-peer movements. And so he's saying, not only am I doing this, but I'm also going to put the pressure on my peers a little bit because I feel like we as a group have a responsibility to do this.
Yes, absolutely. And I love his, I just was on their website not long ago, and I just realized it used to be, Pledge 1% used to be equity, time, and product, I think, and they've added equity, time, product, and profit. And I think that's a wonderful example of some things we've talked about a little bit earlier of all the ways that people can benefit an organization. So it's not just money, but how can they donate 1% of their time? How can they donate 1% of the product they're creating to help nonprofits and help make a difference in the world? And then the last one that we have here, Joe Gebbia, is one of my favorite new up-and-coming philanthropists. You guys have little donor crushes sometimes. He's mine right now. So he is one of the co-founders of Airbnb and also recently signed the Giving Pledge. So I think for me, he's just kind of one to watch, but I think he embodies a lot of the traits that we're seeing coming out of Silicon Valley and the tech world as it pertains to philanthropy. So he's, as I said, he's fairly new to philanthropy because he's just making his money. And what that means for us is that he's probably really just finding his philanthropic passion. So it's an excellent time to kind of figure out what he's interested in, what difference he's going to make, and it's an excellent time for organizations to come alongside him and help him so that he knows he can kind of create that philanthropic image himself. He also, I think, embodies this idea of fixing a broken system versus just putting Band-Aids on problems. And I think we're seeing that come a lot out of Silicon Valley and other places, and definitely with this generation in general. But how do we not just kind of fix, how do we not just attack or create solutions to you know, systematic problems, but how do we actually go about changing the system that creates issues in the first place? And the other thing that I love about him is that he's okay to fail, and he's okay to take on issues that are not necessarily mainstream. I think a lot of times in the past we've seen donors really want to take on issues that they think you know, are issues that look good for them. It kind of helps in their reputation. And then also they want their money to go to sure bets. They want money to go to things that they know are going to make a difference. And one of the things that I love about him in this whole new generation is they're okay to spend money to try to find problems to these systematic issues, and they're okay if it doesn't work because that's, for them, that's just part of the learning process. It's part of figuring out one more thing that's not going to work. So I love that they're willing to just kind of take big bets on different issues. You can kind of see that he's one of the founders. You guys may have seen the Audacious Project, which is an initiative of TED that's recently taken on a couple of big bet projects, and he's one of the funders of that. So the other thing that I think he represents, and I just want to mention here, is that he I think represents this new tech donor. So I get a lot of requests, hey, can you find, you know, this new tech donor, we want to ask him for a gift, can you see what his capacity may be? And I think it's important to realize when you are looking at new tech donors that a lot of times their money, at the beginning at least, is just on paper, right? They may be a part of an organization that has this huge valuation, but they're not yet totally seeing the return of that, and they won't until they have a proper exit. One example that kind of contradicts that a little bit, as I was looking at, I've just recently done some research into the SNAP IPO and some of their founders, and I thought it was really interesting that they had taken out some loans. So before they IPO'd, their founders had taken out a $15 million and a $5 million loan from the company, which they then paid back when they had a successful fundraising round. So there are ways that some of these young founders can take out money from the company before there's a proper exit, but most of the time you're going to be waiting for a proper exit before they can make a large gift to your university. And that, of course, is if you're not taking pre-IPO stock, which is a whole separate conversation. So.
Yeah, and I'm glad, Angie, that you brought up that risk tolerance, because I think that's one of the things that's most exciting about this new generation of donors, and it's a real opportunity for us and our organization. So if you have, you know, new programs that you're wanting to try out, I think these are the perfect prospects. And I think it's one thing that's kind of exciting about it is that you can be honest in a way that you might not have always felt comfortable doing previously. And so I think, you know, these donors are perfectly comfortable if you come to them with a proposal saying, we're not sure this is going to work, but we think it's worth trying, and here are the reasons why. I think it's just like, you know, we really need to have our homework done before we go to them and put that kind of proposal. So we need to be able to say, this is why we think it'll work, this is how we'll know if it's working, this is how we'll know if it's not working, and then to really stay in touch with them through the process, because it's going to be very exciting to them, win or lose. You know, like Angie said, if it fails, I think they're okay with that, as long as you can come back and say, well, that really didn't work, but because we know that didn't work, it puts us in a better position to try this next, and, you know, here's how we're going to apply those lessons going forward. And that, number one, they may be willing to fund version 2.0 of whatever you decide to try, you know, once you've sort of learned your lessons. And number two, if it is working, then they're going to be really excited to have been part of the formation process and are probably going to be very willing to double down and, like, help you, you know, take it even further. So this is a slide, we just put some sort of family pictures as illustrations, but the point that we wanted to make here is in families where you are looking at multi-generational wealth, it's really important to try to identify who the philanthropic heir is. So who's going to be sort of leading that family's philanthropy in the next generation. And some of the things to look for in understanding that are, if there is a family foundation, look at, you know, who's sitting on the board of that foundation. Is it just one member from each generation? Is it a certain branch of the family? So, you know, if it's in the second or third generation, does it seem like one sibling's line is sort of taking over making those decisions about philanthropy? And then also looking at, as the children are coming of age and getting older, what are they doing professionally? So one of the examples on here, the second from the left, is Emma Bloomberg, Michael Bloomberg and his daughter Emma. And so Emma worked as a young woman shortly after graduating from college, worked at the Robin Hood Foundation, which many people have pointed to as sort of that was good training for her to sort of understand from the perspective of the nonprofit what philanthropy is all about. She also, I think, worked for the City of New York, so she's sort of got an understanding from the public policy perspective. And you can see that in the work that she's doing now in the education space, that she's kind of applying those lessons that she learned both from the perspective of the nonprofit and from the government perspective to the work that she's doing.
Yeah, I think one other big trend I think Elizabeth and I are both seeing, and I think a lot of the organizations that we are working with are seeing, is that this next generation is also starting to take the reins and starting some of their own organizations. But I think the way they're doing that points to some really important trends and things we need to be thinking about within our organizations. So the first is a former angel investor with Facebook, Dropbox, Airbnb, and Uber, and he launched Coachorg, which is a nonprofit that's dedicated to the vision that every student in schools should have the opportunity to learn computer science. But I think the really important thing to know is while he made a lot of money in tech, he now sees his mission as giving that money or giving that opportunity to others. So he not only founded the organization, but he now serves as the executive director, and he's really pouring most of his resources into it. He sees it as his mission and kind of the #1 cause that he's willing to support, which means he's probably not a great donor for your organization, but he is totally, you know, pouring his resources into to making a difference in the world. I think one of the takeaways from that is it's a huge shift onto infrastructure, talent, and capacity building. So one of the things, if you've seen some interviews with him about Coachorg, he talks a lot about talent. And actually Coachorg has brought people over from Google, which to me says that they take talent acquisition very seriously. They're probably not afraid to pay their people really well. And they really have this emphasis on bringing smart people to the table to tackle big issues. So I think one thing that's really nice about that is it probably they're taking a step back from the traditional program admin ratios as a measure of nonprofits, and they're really saying if we want to make big changes, we're going to have to really focus on capacity and infrastructure at nonprofits so that they can have the resources they need in place to tackle these big issues.
So we wanted to just, we did a whole presentation on Giving Collective, so we won't go too far into it now, but we do feel that it's relevant to this conversation. Again, going back to the earlier point that we made about the importance of collaboration and cooperation, I think that Giving Collectives are something that really tap into that impulse. So follow up with us after the fact if you're interested in seeing more about that presentation. But also just as far as thinking about engaging young donors, I think that the notion of collective giving is something that's really attractive to younger donors and maybe a great way, like an initial gift to start to get younger donors involved at your organization. And one thing that we really love about Giving Collectives too is that it's a way to broaden our donor base really in every sense. So it's a way to engage donors at all giving levels, and particularly in groups that are historically have been underrepresented maybe in major gifts philanthropy. And so it's a way for individuals to make a smaller gift that still can have a large impact. So if they're younger and don't have control over their family wealth, maybe this is a good way to get started. Or if they're younger and just getting started in their career, maybe their giving is going to be smaller, but they'll be heavily involved as volunteers, and then down the road, as their earning power increases, they will already be engaged and be more likely to kind of step up to make major gifts themselves. And so this is just a reminder, again, that this is hard stuff, and a lot of sort of the traditional model of philanthropy, I feel like, is starting to blow up a little bit, at least in the minds of our donors. And I think that's really exciting, but also, like, if it feels hard to you and you kind of think like, I don't know what we're going to do because all the things we've done maybe aren't working, to sort of acknowledge that, but also to power through it and see that if you take the time and put in the effort with these younger donors, there can be a very big payoff both for you and for the donors themselves and on the world. I mean, what we're all doing here, we all work for the organizations that we work for probably because we feel good about the things that they're doing in the world. And so if we can kind of keep our eye on that and realize that that's what excites our donors too, and that can help us kind of find the energy to think about the hard ways to tackle it. So to that point, we wanted to share these questions. These pulled out of a report called The Giving Journey, which was produced by Open Impact, which is an organization from Silicon Valley, and they talked to donors about sort of how they thought about their philanthropy and what moved them towards making major gifts. And so these are some questions that we just thought are great ways, great questions that you could even just hand off to a gift officer and say, you know, here are some of the things that you can talk about with your donors or with your prospects. And one of the things that I think is interesting about the Giving Journey report is that they talked about the fact that many people are turning to wealth advisors for suggestions on philanthropy, but that the donors that they talked to said that while they do consult their wealth advisors, they don't always feel confident that their wealth advisors have a good understanding of philanthropy or how philanthropy works and how nonprofit organizations work, and also that they didn't feel like they knew the right questions to ask their advisors to get that sort of information. So that's where I feel like our role as nonprofits, and specifically for the major gift officers that we work with, is to kind of mediate those conversations between the advisors and the potential donors. And so if you can sort of start to get at the heart of it and what is it that the people want to do with their wealth, what are the problems that they're trying to attack, and what does it mean for them personally? If you can open up those conversations and then start to understand how your organization fits into that, and then the financial advisors can bring their professional advice about, you know, sort of the economics behind all of it.
Absolutely. I think it's really important to remember, especially with this next generation, if they're coming from families of wealth, that really it's an exciting time for us as organizations to come alongside them, walk alongside them, and help them find their place in their family's legacy. You know, they're just trying to figure out who they are as donors and how they're going to impact in the world, and it's a time for us to really help them dig into their values and really think about what their values are and how those values can be transformed into philanthropy. So I think for us it's really just about helping them kind of go all in, helping them become big donors.
And so these are a couple organizations that we would encourage you to take a look at. I'm going to skip over this one because we want to get to some sort of more concrete takeaways, but these are 3 examples of organizations that we feel like have done a really great job of reaching out to the next generation. Again, if you want to dig into any of this more specifically with either or both of us after the presentation, we think it's fascinating and we'd love to talk about it, so we'd be happy to go more in depth. But as far as thinking about, you know, what are some things that you can do at your organization, we really wanted to just point out that as prospect, if you work in prospect research, I know not everyone on this call does, but many of you I think do, and if you work in prospect research, read as much as you can about all this stuff and then tell people what it is you're reading, because most of our major gift officers, although this information is clearly very relevant to their work, they spend most of their day out meeting with people, and they probably don't have the kind of time that we do to really dig into understanding what some of these trends are and to looking at the patterns, you know, across large groups of people. So definitely sort of verse yourself in it and then be brave about speaking up when you see it playing out, you know, in real life with your prospects. Also, I think it's just sort of from a data perspective, it's really important to have a handle on who these people are and to kind of capture who your next generation prospects are. One organization that I worked at, we had 2 codes that we used in our database, and so one of them was called Wealth to Be, and one was called Potential Wealth. And the intent there was to sort of differentiate between heirs. So heirs were the wealth to be, and potential wealth were people who seemed like they were on a career trajectory. Maybe they didn't have the ability to make a major gift at that time, but it looked like, you know, it was a sure bet. So people who like founded a startup company maybe, or people who were working in finance and hedge funds or something like that, maybe at a lower level, but you know, you could see that if they continued on that path, they were going to make considerable money. So again, just think about, is it meaningful to make that distinction in your organization? Maybe it is, maybe it isn't, but have some way, like some code that you can put on people's records so that you can easily pull a list of these people, so that if you're doing prospecting for a new project or if you're targeting an event at younger donors, you know, make it easy on yourself to pull those people out. Relationship mapping, again, I think this is something that the field of research has come a long way on being more sophisticated with being able to do that. But so I think just the importance of identifying who your key connectors are, but also understanding that that's a great way in many cases to engage younger prospects. So, you know, millennials and younger are very tuned into what their peers are doing, and in many cases they're really eager to make connections with their peers, and also, as we said earlier, to be actively involved as volunteers. And so getting, if you know people of this generation who are willing to be helpful, that's one thing that they can do for you, is make introductions to other people in their networks. And also, as part of this, one point we wanted to make is that particularly in multi-generational families where wealth is being passed down, and especially at the very higher end, these people are coming into contact with each other all the time. A lot of the investment banks and wealth management firms will host like retreats and conferences for the next generation to understand wealth and talk about philanthropy. And so, you know, they'll have like these 3-day retreats at fancy hotels where these people will come together. They're often vacationing in the same spot. They have a lot of the same hobbies, whether it's, you know, equestrian sports, things like that. So they're coming into contact with each other. So chances are, even if they aren't geographically in the same place, especially at the very high levels of wealth, they're likely to know each other, and they may be willing to make introductions within their network. So definitely don't overlook that. So if you're interested in further reading, we want to share these resources with you. I know we're a couple minutes over time. If you're able to stay on the line, we're happy to take some questions. And if not, please feel free. Our contact information is here, so please feel free to reach out to either one of us. We'd be happy to continue this discussion. And Corinne, if you have any questions, we're happy to take those.